Hi, I'm Ross Mayfield, investment strategy analyst at Baird. It has been a tumultuous first half of the year, to say the least. And so I'm thrilled today to be able to speak with two experts from Strategas, a Baird company, as we enter the second half of the year. First, we'll speak with Nicholas Bohnsack, head of portfolio strategy and president of Strategas, about all things markets and the investing landscape, before kicking it to Dan Clifton, head of Washington policy research at Strategas, to talk everything politics and policy in a midterm election year. So without further ado, let's kick it to some questions for our experts at Strategas. Thanks.
I think as we look out through the summer and into the balance of this year, we have to consider that there is a fair amount of uncertainty with respect to the economic outlook. And I think if anything has surprised us, it's been how delayed investors and their clients have been to sort of coming around to the view that it's going to take more from policymakers to really curb the effects of inflation. There's almost a complacency in the market and an intention really to think of market activity as being V-shaped, when in reality, by our lights, a market bottom is much more of a process. And it's very likely going to take a level setting of both price and fundamental expectations, likely through the prism of PE ratios and valuation, as well as an anchoring of inflation expectations. And those are tough hills to climb. You know, one of the interesting things about this environment and the application of both fiscal and monetary policy, so what the government and the Federal Reserve have provided to taxpayers and the economy over the last number of years, is it actually makes handicapping recession somewhat difficult. There are clear pockets of strength in the U.S. economy, most notably the labor market. And so it's very likely that while we see a slowdown in growth here, as we have for the first half of this year and perhaps into the second half of this year, labor will remain and jobs will remain plentiful, and the labor market will remain strong, such that we may actually almost evidence a second recession, a double dip recession, if you will, out into 2023 or even 2024, as the Fed continues to have to press to curb inflation. And so the knock-on effects for corporate operators really are very challenging. There's the money illusion, which is driven by inflation, makes the nominal level of revenues, the nominal level of profitability look as though it remains high. But margins come under very acute pressure, and to the extent to which the labor market remains strong, earnings, the cost of labor and earnings share of income continues to rise. And that's not really a good recipe to curb inflation. So we would anticipate corporate profit margins will decline, if not the nominal level, outright. And that in part is going to help contribute to the further contraction in profit margins. Our estimate for 2023 is below the consensus in large part for two reasons. The first is that we really don't have as much confidence in the revenue stack, which is, say, the ability of corporate operators to maintain previous levels of gross sales, and moreover, in their ability to pass on costs to the end consumer, keeping profit margins elevated. So, that simple calculus conspires to draw earnings lower when they're ultimately reported. And of course, we've seen an increase in that cost profile just in the beginning of this year, as the transient elements of price have started to elude not just the consumer, but also the producer. So we find ourselves with an estimate somewhat lower than the street. And I think that difference is exacerbated also by the fact that we really haven't seen altogether that much downward revision from sell-side stock coverage analysts. They continue to have relatively lofty expectations for profit margin. And it's our suspicion that as the second quarter reports, and there are some disappointing reports that come with it, whether they be on the inventory side or simply on the cost side of the equation, you might begin to see street estimates start to move lower as we look out towards the balance of this year. I think there's really two key elements, and at the highest level, I think as you consider the very likelihood that a recession is sort of closer at hand than not, and we can spend some time debating on when that may ultimately take hold, the overriding consideration for investors in the moment appears to be inflation. And I think that argues for a more conservative portfolio by way of allocation and construction. We have generally taken a bias towards domestic equities over international shares, particularly in the developed markets, namely Europe, where there appears to be a little bit of a hesitancy on the part of the central bank to fight inflation, and of course the offsets that come with the invasion of Ukraine. So our preferences remain domestic. We have tended on a style basis to favor value over growth, and that's been largely the story since the latter part of 2021. And it continues to be so as we move forward. As it relates to size, large, mid, or small, I think there's opportunities across that spectrum, although a more conservative positioning would generally lead investors to move up the cap spectrum, but it would have to come with some granularity and some selection bias. So overall, a fairly conservative approach as we head in to what potentially could be a recession over the next 12 months. And thematically, we address that through a cyclical defensives type of allocation, where we're trying to take advantage of some of the latent pockets of strength, notably the labor market, but mindful of the fact that quite a bit of growth was pulled forward into last year, and that the growth profile of the economy and the market is generally slowing this year. Given all the uncertainty in the economy and the stock market, we want to thank you for spending some time with us today. I'd like to turn it over to my colleague and partner, Dan Clifton in Washington, who will discuss some of the political and policy ramifications in the current cycle.
Hi, I'm Dan Clifton, Head of Policy Research for Strategas, the investment strategy arm of Baird. I want to take a few minutes today to talk about some of the bigger macro, legislative, and election themes that we see heading into the second half of 2022. Since the financial crisis, we've been arguing that economic volatility is creating political volatility in the United States. More specifically, a much slower level of economic growth is leading to greater political turnover. In fact, the US has had 8 federal elections since the financial crisis, and the voters of this country have removed the party in power in 7 of those 8 elections. We look out to November, that could possibly be 8 out of 9 elections. And so that continuous political volatility of switching political parties has created policy uncertainty. That policy uncertainty has made it harder to get new investment. As a result, what we are starting to see is companies in oil are doing less energy investment, or companies in healthcare are doing less investment because they're worried about the rules changing. Much of that was compounded by the events of 2020. We call 2020 unprecedented, but at Strategas, we tried to measure what that unprecedented was. And what we came up with is that there were 4 transformational events that happened in 2020 that are now leading to big tail policy events. Those 4 events were a recession, a pandemic, a mass protest, and a presidential election. All 4 of those events lead to big policy changes. And that's important because the last time we had these 4 events happen in 1 year was in 1968. If you look at what happened after 1968, we had massive policy changes. We had the end of the Bretton Woods financial system. We had the OPEC oil embargo. We had inflation. We had a war. We even removed the president of the United States from office, something that is very rare and rarely happens. And so when you put all that together, it feels very much like we're at the beginning of that process, the after effects of those 4 transformational events. And as investors, we have to recognize that there could be big policy changes occurring that we're not normally used to seeing. At Strategas, we have 3 major policy frameworks that we monitor. Those are fiscal, monetary, and geopolitical. It is very rare in any year to have one of those 3 get completely upended by the framework by which we're used to. For investors, 2022 so far has seen all 3 of those policy frameworks get completely upended. What do I mean by that? Let's just look at monetary policy. We have the highest inflation that we've had in 40 years, And that means that monetary policy for the first time is trying to get the inflation out of the system. Every interest rate increase that we've had since 1982 has been to prevent inflation from happening. This time around, they're trying to actually take the inflation out of the system. And that is a much more difficult job of our monetary policy makers. You look at the difference between inflation and the 10-year treasury yield, it's the widest gap that we've ever seen in history. And at some point, those two are going to have to resolve with inflation coming down and interest rates going up. That's changing the framework by which we evaluate monetary policy. Let's think about geopolitics. The most significant event this year so far has been Xi Jinping and Vladimir Putin standing up at the Olympics saying that they are going to change the new world order. The Russia-Ukraine war is just a byproduct of this changing world order. And so what we are seeing are very historic events flying by us in real time. Finland and Sweden trying to join NATO. That is an unprecedented event. You're starting to see more geopolitical events happen in Asia, around China, around Taiwan. You're seeing Japan talking about possibly creating a NATO for Asia. Again, a very unprecedented and unique event happening. And that's telling us that the world order is changing, that natural allies are changing, and the impact of that is actually starting to lead to greater geopolitical challenges, very similar to what happened after, before the Berlin Wall went down, where we're going to have more larger and long-lasting geopolitical issues in front of us. And then finally on that framework is fiscal policy. Right now, a lot of clients say, Dan, if you tell me we're in a recession, that's pretty bullish for stocks because we got a little bit more down on the S&P 500 and then we'll hand out checks and we'll be back off to the races, just like we did during the pandemic. And I just think that that model is broken because debt to GDP ratio in the United States is now 120%. And there's concern at the federal level that handing out checks to people have created some of this inflation. And so my belief is that if we're going to do legislation to deal with higher inflation or deal with a potential recession, it's more likely going to be on energy policy than it will be on fiscal policy, which is the traditional stabilizer for recessions. And so when you put all that together, all three of the frameworks that investors have been using for the last 40 years or so have been completely upended. And that's not a bearish event, but that means that investors need to adjust to that changing framework. The midterm elections are just a few months away, and Democrats are in a rush to get as many policy victories done before they face voters in the November midterm elections. The top priority is passage of what we call Build Back Smaller, a smaller, more slimmed down version of President Biden's Build Back Better agenda. As I spoke about in our 2022 Outlook video, the Democrats will make one last chance to try and get this legislation passed. And that period of time is really going to be between July 4th and August 6th. Now, they have until September 30th to be able to pass this legislation through a special procedure called budget reconciliation. That allows Democrats to pass legislation with just 51 votes in the Senate. They can pass it on party line votes. There are negotiations going on between Senator Manchin and Senator Schumer right now to see if they can get some sort of an agreement that focuses in on four areas. The first is about $600 billion of renewable energy spending, wind, solar, energy storage, biofuels, nuclear, all sorts of new types of energies designed to take the U.S. and diversify off fossil fuels. The second is increased healthcare spending, more subsidies for the Affordable Care Act. The third are tax increases. Anybody making over $10 million would be subject to a 5% surtax and over $25 million an 8% surtax. A new tax increase on small business income of 3.8%, as well as two corporate tax rate increases of a 15% minimum corporate tax rate and higher taxes on U.S. multinationals. The final piece of this legislation is some sort of drug price cram down on drugs that are involved in the Medicare system that will start in 2025. The goal of this is to raise more taxes than spending and claim that those higher tax rates and a lower deficit will reduce inflation. Never in history have tax increases reduced inflation, but that's what's driving the process of more fiscal spending, even as we are in a high inflation and slow growth environment. It won't be easy. We put about a 40% odds on that, But clearly, if Senator Manchin and Senator Schumer are able to reach agreement in the next few weeks, this process can move quite quickly. Midterm elections generally have been very bad for the sitting president. On average, a sitting president loses about 29 seats in the House of Representatives in their first midterm election year. There are only 2 presidents over the last 100 years to actually gain seats in the midterm election. Because midterm elections are referendums on existing presidents, the president's approval rating is the single best indicator of the number of lost seats that a president faces. In fact, there's about an 80% correlation between the president's approval rating and the number of lost House seats. President Biden's approval rating is somewhere between 40 and 42%, very similar to Donald Trump's 4 years ago, and consistent with losing somewhere between 30 and 40 House seats in the November midterm election. Of course, that could change over the course of this year, but it's very likely the Republicans will gain the 5 seats needed to win the House of Representatives in the midterm elections. The Senate is a lot less known outcome at this point, largely because despite the president's poor approval ratings, the Democrats in key states like Pennsylvania, Georgia, New Hampshire, and Ohio are running much better than what the president's approval rating would suggest, and it's keeping the Senate races close. The Republicans only need 1 seat to win the Senate. We think that they're probably going to pick that up, but it won't be until October where the equity market begins to get confidence in what the election results are going to be. We are often asked, what is the investment implication of a change in political parties? And we would argue just getting to the election, no matter who wins, has been the most significant effect for investors in the midterm election. In fact, midterm elections tend to be very volatile for stocks. The S&P on average declining by 19% in a midterm election year. On average, 1 year later from that midterm election bottom, stocks on the S&P 500 are up by an average of 32%. And I often like to tell my clients that the S&P 500 has not declined in the 12 months following a midterm election since 1946. Now, that doesn't mean that that's going to happen this time. That's a historical pattern. But we generally see large sell-offs and big bounces in midterm elections. Just getting to the election has been the catalyst of those midterm elections. Thank you for your time today. Please reach out to your Baird advisor if you have any specific questions.